It's the Real Estate Podcast, brought to you by ANZ Home Loans for financial well-beings.
If someone is talking to you about a property, they're selling you, they're not advising you. So, as I said, the influencers that are out there, there's very big marketing, and marketing is there to do one objective, which is to sell and connect with you emotionally to sell you a product.
And that is Richard Crabb on the Real Estate Breakfast this morning on the last day. Yes, last day of October. November is arriving tomorrow. Any day now, you'll see somebody put up Christmas decorations along with the dreaded Christmas music. Is there anything worse than Christmas music at this time of the year? Instead of music, we're delivering your property news and interviews with market analysis across Australia every morning. That is 7 days a week and streaming right now on Spotify and iHeartRadio. Yeah, Friday, end of our working week. Looking forward to this weekend, October the 31st. Here's a troubling thought and a question for you. When watching a video, can you figure out what is real and what is BS? Because we've officially entered the I don't trust my own eyes era. AI-generated videos, they're so realistic now that you can't tell if you're watching a real video clip or an imposter posing to be real. You know, this whole line between reality and fabrication has blurred so much that the expression seeing is believing no longer applies. I mean, that's where we are in 2025. Seeing is believing does not apply. It's redundant. And I've almost reached the point, I'd be interested whether you're with me here, where I don't trust any videos or photos that might be a little bit edgy or provocative. And these videos, they're only going to get better with time, which means that we will live in a time in the not too distant future where we're going to be living in an alternate reality. The 1990s was such a different time and place. I mean, I would pay to go back to the 1990s. Just name your price. Sadly, though, we can't. Let's go to Brisbane. That's somewhere where we can go to and catch up with Richard Crabb from Aspire Property Advisor Network. And good morning to you, Richard. Welcome into the Real Estate Breakfast this morning. How are you getting on with these videos? Is that a problem that you're starting to struggle with like I am?
Oh, good morning, Craig. Yes, couldn't agree more. I find myself being quite tech savvy and now, like you said, having to go and look twice because the realism of videos and photos that are coming out from AI are just so realistic. You really have to look twice now.
Yeah, I hate it. It's a real bugbear, and as I say, it's just going to get worse. Right, let's turn our attention to some property because we're going to be looking at buying with emotion and the costly mistake of that. Also, the power of a plan, we'll be talking about that. Getting the structure wrong and how much money that is going to cost you, and selling too soon. So first off, let's talk about buying with emotion. You know, too many first-time investors, they do fall into the trap of buying with their hearts instead of their heads. Emotion often clouds judgment, especially when buyers choose areas that they're personally attached to. So give us your thoughts on that on our Friday morning, Richard.
Really, I guess the starting point for that is we see too many investors do that mistake. It's probably one of the most common ones because that's what people feel comfortable with. Investing in property can be very rewarding, but you really have to take the emotion out, bring the data in, look at the numbers because they don't lie. Our hearts can cloud our judgment and we might think we're making the right decision, but we need to take that step back and look at the data.
Yeah, in terms of the data, you know, you got to look at population growth. How many times have we said that on the podcast? Infrastructure, very, very critical piece of the pie. Jobs as well. And also yield. You've got to look at that, not lifestyle appeal.
Correct. And those fundamentals that you mentioned then are the key element. There is good and bad property in every location around Australia. And it's the numbers and the data tell that story. And when you unpack that, looking at the socioeconomic, looking at the population, what's the underlying economic drivers? What's the population density? I guess there's two questions that, if you really want to break that down at a high level, is when you're looking at an investment property, you want to really assess who's going to be my tenant when I'm renting that property, which ties in with their income levels, the quality of tenant that you're going to get, which can come into the yield and the income generation. And then the second question you've always got to look at is your exit strategy. If when the time comes I go to sell this asset, who's going to want to buy it? And looking at elements like owner-occupier to rent ratios in a location can give a good indication of people wanting to buy there to live. Those sort of key elements can really help step back to understand the potential of an asset to perform, because that's what ultimately you're looking to do. Is you're not buying a home to live in, you're buying an income-producing asset. Look at the data and the picture, and that can help you make a good decision.
Many investors, let's face it, they just rush in without that clear strategy. Strategy number one, you've got to have that strategy when investing. You can't make it up as you go along. Without a plan, it's impossible to measure success. Are you chasing capital growth, rental yield, or long-term income? That is all pretty important stuff, and the right property should be the result of that plan, not the starting point. So all of those things, valuable advice, Richard, and want to talk about getting the structure wrong as well. We'll come back in just a moment. We'll look at that and that key point about selling too soon. You don't want to be doing that. We'll talk after this.
Listen to expert perspectives with exclusive real estate conversations, and supercharge your knowledge base with us.
We have never featured St Mary's because there's so many of these suburbs right across Australia. Amber, give us a breakdown and tell us a little bit about the demo, etc., on St Mary's.
Yeah, so St Mary's at the moment is a booming suburb for Western Sydney, more just due to affordability. Most of the people buying in St Mary's are young families or young couples hoping to enter the market and buy the first property. Medium house prices in St Mary's are around $1 million. Units are around 450,000, but townhouses at the moment, which is the hot stock, around 800,000.
Okay, so let's break this down a little bit further, because you were telling me off here there is an awful lot of these first home buyers gravitating to these townhouse stock in St Mary's. So tell us a little bit more about that phenomenon.
Most brand new townhouses are now ranging anywhere from 800 to 850,000, which a lot more young families want something brand new with less maintenance. So a lot of buyers are snatching onto that, which is the first entry, like I was telling you earlier. They'll probably live there for around 5 years, use all that growth, and then eventually upsize into a house. So they are getting either 3 or 4 bedroom townhouses. On average, they're around 180 square meters, ranging anywhere from, let's say, brand new to even 10 years old.
Eager to expand your property expertise? Enhance your real estate know-how with us. It's the Real Estate Podcast.
It is a Real Estate Friday, last day of October, heading into another weekend, and we're looking at getting the structure wrong when investing in property. Don't take a good situation for granted. For example, even if you buy a great property, the wrong ownership or finance structure can totally wipe out your returns. Very, very expensive lesson here, Richard, for people to take note of.
Yes, and it's always upsetting when we see clients that have done that. Most investment mistakes happen before the purchase, in poor planning and rush decisions. As you said, if you get these things wrong, you can't just turn it back and change it without it being very expensive. Things like the structure. Every individual person's circumstance is unique to them, and getting the right advice from the right professionals, that the structure that you buy the property in with your ownership could be doing it as joint tenants. It could be tenants in common. So there's different ownership if they're buying it in individual names. And then there's other structures that they might get advice to look at using as well. So very key, because if you do get it wrong, very costly to change it, because it's the equivalent of having to sell the property and all the government fees and charges that would apply to do that.
The impatient investor, we have all bought properties and held them for a short period of time. Being impatient, now that is a big driver for killing profits. Apply the old cliche to every investment that you make. Property works in cycles, so play the long game. Keep financial buffers in place, we talk about that a lot, and hold it nice and steady.
Couldn't agree more. And investing in property comes back to what we talked earlier, which is having a strategy and a plan. And liquidating properties too soon can really diminish the returns or what you may have achieved. Property does go in cycles, and we've seen that for decades, and the data shows that. And holding property for the longer term, will normally see you benefit from those both property cycles and that long-term growth. A good example with that is COVID. We saw a lot of investors panic with COVID when interest rates started going up. Some people panicked and sold. And then, unfortunately, those properties that they sold as a knee-jerk reaction and sold too soon then had some of the largest growth in the last period of time, and they've missed out on significant profits, which all ties back into that stress testing and having contingencies. Interest rates are low. Make sure you run the numbers and do the what ifs. If interest rates were to go up higher, could I still afford to pay for this property and hold it? And if the answer is no, well, then you need to reassess the budget and the property that you're looking at.
The other thing too is being sold the dream. Like when agents, etc., are showing you a property, they're in sell mode. They're wanting to sell you that property. That is their primary objective. And it's the same with influencers on social media. They're doing the same thing. You've got to be so careful when looking at property and, standing there and looking at that potential investment property through the lens of an investor.
This ties back in with the very first question, buying with emotion in your heart. In this day and age, there's so much noise out there, and free advice can end up being the most expensive lesson you'll ever learn. As well as when you're being sold, if someone is talking to you about a property, they're selling you, they're not advising you. So as I said, the influencers that are out there, there's very big marketing, and marketing is there to do one objective, which is to sell and connect with you emotionally to sell you a product. So the advice we give people is, drop the glossy brochures, drop the slick sales presentation, or the sales agent who's telling you everything you want to hear. Property success isn't found in a brochure or a sales seminar or with a really good sales agent. It's built through structure, strategy, and time. So help to navigate that noise, make informed decisions.
All right, good stuff, Richard. Plenty of takeaways there. Enjoy the last day of October in Brisbane. And thank you so much for coming on to the Real Estate Breakfast this morning.
Thanks for having us, Craig. Have a fantastic finish to the month.
Every morning from 6 a.m. across Australia, we deliver you the latest property news, commentary and predictions from Perth to Cairns and from Melbourne to Brisbane, 7 days a week.
It's all about drama. It's all about creating controversy. It's about people and relationships. It wouldn't be the show it is if everything ran smoothly, everyone got on well, all the houses sold for healthy profits at the end of the day.
Somebody has dreamed up a number and said, this is what we're going with. That's it, 2.99. All the agents would have been looking at themselves saying, what is going on here? There's no way. That is miles off the pace.
The main problem was the location. And these homes, I felt they were on a fairly main road coming into town. At the rear of them, they were surrounded by a new subdivision. For me personally, it was the location that let these properties down at a high price. If I could have picked up our house and put it in a different location in a lovely, country lane with a beautiful view, yes, it would have been worth $3 million every day.
We connect you to the best real estate information across Australia. The Real Estate Podcast.